Morning, everyone. I'm Dan Gremenpray, National Vice President of Wealth Distribution here at Canada Life, and your host for today's mid-year market outlook event. I think we can all agree that 2022 continues to challenge us as investment professionals. Inflation is close to a 40-year high. War in Europe is straining commodities, and the chance of recession has Canadians on edge. It's times like these that clients need us the most, whether that means helping them understand the impact of market corrections or finding their true risk tolerance through difficult times. You're helping them plan for life as they know it. And as their lives change, our investment solutions are designed to change with them. So no matter how they may be impacted by market volatility, Canada Life can provide them with investment solutions and support that help them meet their unique needs. At Canada Life, we have a solid foundation of more than 170 years experience growing and protecting the wealth of Canadians. We pride ourselves on our long history and commitment in the industry. Thanks to your support, we're a market leader in gross sales of segregated funds and hold $98.9 billion in assets under management and administration in Canada Life mutual funds and seg funds. Our focus is to bring you high quality funds that are relevant and competitive, and they're always positioned to win. Through the Canada Life shelf, you have access to a breadth of traditional and niche mandates that are diversified across regions, asset classes, managers, and management styles. This includes an offering among the widest selection of seg funds in Canada to help you offer a steady approach for your clients during times of uncertainty. From standalone mutual and seg funds to managed solutions, you can curate our product offering to fit your clients' needs at every stage of their lives. And we offer these with a variety of compensation methods to match the business model for your practice. Now, by combining these with your knowledge of the markets and your clients' goals, you can feel confident that you're providing them with the right investment solutions. We're also committed to offering you world-class investment management solutions that help scale your wealth business. Canada Life Risk Managed Portfolios, which we added to our suite of managed solutions in 2020, help you stay efficient while also addressing the market volatility that we're dealing with today. In our interconnected world, it's important to understand how the global economy is evolving and how it might affect portfolios. To help us with this global perspective, I'm joined by Lenny McLaughlin, investment strategist with Irish Life Investment Managers. Lenny is a veteran in the industry with over 25 years experience. He was appointed fund management economist in August of 2012 and is a member of the Asset Allocation Committee. Previously, he was responsible for managing the financial and retail sectors in Irish Life Investment Managers' active global equity funds. For those not familiar, Irish Life Investment Managers, also known as ILIM, is a global asset management firm with a reputation for client-led solution development and investment innovation. The team is entrusted with assets exceeding 101 billion euros across a broad range of asset classes and investment solutions. We'll try to cover as much ground as we can to help you with client conversations and portfolios, increasing market volatility, inflation, and supply shocks, and how Russia's ongoing invasion of Ukraine is likely to affect markets going forward, rising interest rates and monetary policy, and responsible investing. Before we dive in, I do want to go over just a couple of housekeeping items. There will be a Q&A portion at the end of today's call, so please navigate. You can see it on the screen. Please navigate to slido.com using your internet browser or mobile device and enter the hashtag PMConnect. You can add any questions you have for Lenny there, and we'll address as many as possible. There's also going to be a post-event survey that's going to be available to you to let us know about your experience today. You'll see that when we wrap up. And those of you that are listening in live, Canada Life is going to be applying for the continuing education credits following the webinar. You'll receive a certificate by email once everything is approved. So over to Lenny at this point. Lenny, welcome back. A lot has changed since the last time we spoke.
Morning, Dan. Morning, everybody.
Good morning. We're seeing a nearly 40-year high in inflation and resulting policy pivots along the way. The war in Ukraine is straining supply chains even further. China is continuing to face challenges with COVID-19. Here's the first question for you. What are global markets today, or where are global markets today, and what are the major concerns on the horizon that you're seeing?
So Dan, you kind of listed the main issues that have kind of risen since we last spoke, and it's a very changed landscape compared to where it was at the beginning of the year. And the economy globally has moved from mid-cycle to late cycle very rapidly. And that is down to, as you said, this high and persistent inflation that we've seen globally, which has resulted in a significant policy pivot from the central banks, who are now raising rates and guiding to tighter policy at a much faster pace than we've seen in a number of decades. And with that, we've seen yields rise significantly. That's undermined equities in terms of the relative valuation story, but also in terms of the impact it's having, obviously, on growth. And also, you mentioned the Russia-Ukraine crisis and the China lockdowns that we've had recently as well, which obviously are negative for global growth as well. And with that, what you've seen is a significant fall in global equities, as shown here in the chart. Now, it differs across regions. When we look at the various regions, unusually, over the last couple of years, we can see the US is actually the worst performing market in local currency terms this year. And that reflects the fact that the Fed has been one of the more aggressive, I suppose, in terms of this policy pivot and in terms of the guidance it's given in terms of where it expects rates to go in coming months. But also the tech sector in particular, which obviously has a heavy weight in the US market, has been negatively impacted by this rise in yields that we have, because the discount rate that you use to discount those long-term cash flows and earnings from tech has risen. And with that value has reduced, and tech sector in particular has been very, very weak this year. In contrast, what you've seen, I suppose, the UK, you can see it over here, kind of two-thirds of the way along. UK equities are actually up, the only major region up this year. That reflects the high weight that the UK sector has in both energy and commodities generally, but also it is also very defensive in terms of its high weight that it has in healthcare and consumer staples as well. So that has benefited the UK market clearly this year. The other region that has obviously done well has been the Pacific Basin, given the weight that you have in Australia there and the weight in commodities within Australia as well. And Canada, you can clearly see here, has outperformed global equity markets, again, for similar reasons, with that weight that you have in commodity stocks. When you look at the right here, you can see bond markets are down. And usually we would expect, when you have a large drawdown in equity markets, you would expect a buffer or some protection from bond markets. And that hasn't happened this year. And that, again, as you said, is down to that policy pivot that we've seen from the central banks, the sharpest, the most aggressive tightening that we've seen in decades from central banks. And with that, yields having kind of grinded higher from the lows that we saw in March 2020 through the remainder of 2020 and 21, that rise has just accelerated this year. And again, just to give you some sense, I suppose, at the start of the year, US 10-year yields were 150. They recently hit a high of 350. Canadian 10-year yields started the year at 140. We recently hit a high of 360. And in Europe, German 10-year yields were negative at the start of the year, a negative minus 20 bips, and they recently rose to over 190 basis points. And with that, you've seen the worst return in bond markets in over 40 years in some regions. So very, very different scenario and outlook, I suppose, compared to where we're thinking at the beginning of the year. And again, we look at those regional equity markets. The US is now in a bear market. It is down over 20%. Some of the other regions haven't quite got to that level yet. But the first 6 months of the year were the worst first 6 months of the year for US equities going back to 1970. So it's been a long time since investors have seen the type of environment that we've seen over the first 6 months of this year. In terms of what issues you mentioned, Dan, what do we need to look out for? Again, it's those issues that have driven markets year to date. I suppose it's where inflation is likely to go, what the policy response is, and where the peak in rate rises from the various central banks are going to be. And when we get those concerns that have been evident around the global growth, when you get those beginning to abate, and at what level does growth get to? Does it slow? Does it go to recession? All those issues are continuing to overhang markets, and will, we believe, act as a drag in the short term.
Lenny, thank you for that. What can we expect for the second half of the year? And does the outlook differ between developed versus emerging markets?
So when we look at the valuation for equities, after the falls that we've had, Dan, optically equities now look cheap. As of last night, the P multiple on a 12-month forward basis was 13.9 times. The long-term average is 16, so we're well below that. And typically in the past, when we've seen large drawdowns in equity markets, with the exception of the GFC and the Eurozone debt crisis, you can see that markets typically bottom at a P multiple of about 13 times. So it's suggesting there is still some downside, with modest downside from here. Having said that, there are still a number of overhangs, we believe, in equity markets. And one is the relative valuation case. If you look at it here on the right-hand side, there's a number of different ways you can look at this. But what I've shown here is the gap between the dividend of global equities and the 10-year yield in the US is a proxy for global bonds. And when that blue line is above the green line, the long-term average, equities are cheap versus bonds in terms of that gap, in terms of that dividend yield being higher versus bond yields. And over the last 10 or 15 years since the GFC, equities have been cheap versus bonds. Because of the rise that we've seen in bond yields, that has now completely reversed, and equities are actually now slightly expensive versus bonds. So that relative valuation case has been undermined. But also, I suppose that there are a number of other headwinds that equities still face. One is the uncertainty about the global economic backdrop. As you mentioned at the start, there are increasing risks and concerns that we could be moving into recession. And if we are, we don't believe that that's fully discounted in equity markets at the moment. Um, Also, when you look at the earnings backdrop, what we have seen is that growth forecasts have come down, but earnings forecasts have actually gone up this year. And the reason for that is what analysts are doing is this higher inflation backdrop that we have, they're factoring that into the top line. But our sense is that margins will come under pressure as you see input costs rising. Wage inflation is obviously evident globally as well. And we do believe with slower growth, you're going to see a slower top line as well. So we think those earnings forecasts are probably too optimistic. And if you were to plug in more realistic forecasts, and in the case of a recession, if you were to have a recession rather than earnings growth, you're likely to have an earnings contraction. In a worst case scenario, if you were to plug a contraction in earnings into that PE multiple, it would actually rise over 17 times. So I said optically equities look cheap, but I said in reality, if you use more realistic earnings forecasts, they're probably expensive. So overall, we do think there are a number of headwinds still out there for equity markets. We think the risks in the short term are still to the downside. For equities to bottom, what we think needs to happen is that central banks globally need to indicate to investors that they're close to a peak in the terms of the tightening cycle. And we believe that the concerns around global growth have to begin to fade. We don't think we're quite at that point yet, and hence, as I said, we do believe that there's still downside in equity markets. Now, having said all that, I said short term we see some weakness. Long term, we do continue to like equities, and it's one of our favorite asset classes over the long term. What we typically see is that equities discount forward. So again, if we do ultimately move into a slower growth or recession environment, equities will look to the eventual recovery that you have, and equity markets will bottom, and they will recover as they always do. And over the long term, we still expect about 6% per annum returns from equity markets, even though, as I said, in the short term, we do still see some downside risks within them. When we look at various regions, you mentioned emerging markets, Dan. Emerging markets have been big underperformers in recent years, and we do have a chart on this just showing the underperformance of EM equities. And again, they have underperformed in recent years since the GFC, and I suppose a couple of reasons for that. One is the fact that you've seen, I suppose, globalization begin to kind of reverse a little bit, but also that growth premium that EM regions have had historically has begun to narrow as well, and with that you've seen EM markets underperform recently. Now, in terms of valuation basis, EM equities traditionally trade at a discount of about 25% on the PE basis, as you can see in the chart here on the right, to developed market equities. At the moment, that discount is larger than usual. It's about 35%. So it is suggesting there is still some value, or is value appearing in emerging markets. However, for that to be crystallized and for EM markets to begin to outperform, I think what you really need to see is that you need to see global growth and the outlook towards growth beginning to improve, because EM markets tend to be very geared or sensitive to the growth outlook. And you also probably need to see a peak in the US dollar. Again, what you typically see is in a stronger dollar environment, EM equities tend to underperform. So at the moment, again, as those concerns around global growth and equity markets in general continue, we think you could continue to see some short-term underperformance in EM equity markets. But once equity markets trough, once the global outlook begins to improve, and once the US dollar has peaked, we do think once it's a risk-on environment again, we think EM equities could begin to outperform once you see that recovery coming through in equity markets. Just lastly on bond markets, Dan, I suppose when we look at bond markets, we've obviously seen large rises in yields this year. And I suppose historically, again, when we have a chart on this, when we look at historic rates of inflation in the US, typically what we see is that the Fed funds rate, when inflation gets up to these types of levels, and inflation, as you mentioned earlier, is close to 40-year highs, to rein in those very high levels of inflation, what you typically have seen in the past is that the Fed funds rate needs to get up to, or actually above, the level of headline inflation, and we're still well away from that. So, policy is still relatively loose, and historically as well, when we look back over time, the 10-year yield in the States typically tends to peak around the same time the Fed funds rate peaks and around the same level of the peak in the Fed funds rate. Now, at the moment, the market is discounting a peak in the Fed funds rate of about 375. The level at the moment is 150, so we have a long way to go before we hit that peak. And again, our own sense is that the peak may well be beyond that 375 and maybe beyond 4%. All that would suggest that we haven't yet seen the peak in US 10-year yields, and they probably need to move a little bit higher from here. Now, even if short term those yields continue to move higher, we do think on a 12-month view, the 10-year yield in the States will be close to current levels of around 3%. And the reason for that, Dan, is that as you go through the second half of this year and into next year, as you get slower growth in the US economy and an increasing risk of recession, we do ultimately think that the Fed will pause at some point in 2023 and begin to cut interest rates. And with that, even though yields may rise a little bit further in the short term, on a 12-month view, we do think we will see a peak during the year. And in a 12-month view, we do think they will come off that peak in a 12 months time, be around the current levels of about 3% in terms of US 10-year yields.
Outstanding. Thank you for that. I love the passion that you bring to these. I'm being asked that we slow down a little bit. Our interpreters are having trouble keeping up with our pace here. Let's talk about supply chain issues. How have these impacted the market? Do you see that alleviating as businesses return to pre-COVID levels of production?
So supply bottlenecks and supply constraints have obviously been a huge contributor to this rise in inflation that we've seen. And this really has been driven down by this pent-up demand that we've had as economies have reopened, and the fact that production has been slower to come back to normal levels. And with that, you've had increased levels of demand, reduced levels of production, and these supply bottlenecks have been evident globally. And with that, what you've seen is inflation. That has been one of the big contributors to the rise in inflation that we've seen. Now, the New York Fed has developed a global supply and pressure index late last year, and you can see the index here. And you can see how it clearly rose, through 2020 and 2021, hitting a peak late last year. And it has begun to ease a little bit. And we're seeing something similar, I would say, in terms of delivery times, in ISM manufacturing or PMI data globally. So it is suggesting that the supply bottlenecks are beginning to ease, Dan. And we can see that also, I would say, in terms of shipping rates or freight rates globally. They're probably off about 35% over the last couple of months. And again, those log jams or traffic jams that we saw in ports globally have begun to ease as well. So we are seeing those supply pressures ease, and that is a sign that those bottlenecks are fading. But I would say also, Dan, it's also a reflection of this kind of lower demand backdrop that we have begun to see in recent weeks and months as well. So it's a combination of the two, and trying to disentangle both is very difficult. But those supply pressures are definitely beginning to ease from these various measures that we have in place. The caveat I would say, Dan, is that again we go back to China, which is a key part of the global supply chain. With this zero tolerance policy that they're continuing to implement around COVID, what we've had is a number of lockdowns in China, particularly through April. And you can see the spike that we have had in the supply chain index around that time. Now, the problem with China is this zero tolerance policy around COVID is going to last until at least the 20th National Party Congress in Q4 this year, and probably beyond. And with that, I do think there's a risk of continuing waves of COVID in China, new lockdowns. And we do think from time to time we will have blips again in the supply chain like we did in April related to those China lockdowns. So overall, while the pressures are easing, and that's good for inflation, I do think there's a risk that from time to time, as China goes into lockdown across various regions, I do think we will get these supply issues coming back again. Last thing I'll say about supply chains, Dan, is because of the disruptions that we've seen globally, corporates, because of what's happened through COVID and also in Russia, Ukraine, a lot of corporates are rethinking how they manage those supply chains going forward. And in order to secure long-term supply chains, what they're beginning to do is reshore production facilities closer to home. Now, this is going to be an ongoing long-term development. It will long-term improve supply chains, but it too will come with additional costs as manufacturing is located away from those cheaper regions in Asia and China, back closer to home in Europe or the States. And while it will improve supply chains globally over time, it does come with additional costs. So it's kind of a two-way pull in terms of the impact it has on inflation on a long-term basis.
Lenny, are we building toward a global recession? And if so, which region do you feel will be impacted first? Europe, North America, Asia?
The risks around growth have definitely increased, Dan. And again, you go back to the forecast that people had at the beginning of the year. The expectation was the global economy this year would grow 4.2%. Those forecasts have continued to come down in recent weeks and months, and they're now down below 3% for this year. And next year is down to 2.5%, which is below the long-term trend growth of 2.7%. And why people were so optimistic at the beginning of the year, Dan, was down to the strength that was there in the consumer balance sheet. So if you look at the levels of excess savings that have been built up through the pandemic, they had amounted to between 5 and 10% of global GDP. So huge buffer for the consumer, and the outlook for consumption was strong on the back of that. Also, you've had very strong and improving labour markets in terms of numbers of people employed, wages increasing. And at the beginning of the year, I would say inventory levels were low for corporates. They needed to be replenished. Sentiment levels among corporates were positive. So all that boded well, I would say, for the economic outlook. Things, however, have significantly changed. And again, we go back to those higher rates that you've seen from central banks. That's obviously slowing growth. But when we look at some of the leading indicators, they are definitely rolling over, Dan, and suggesting much slower growth. In particular, if you look at the purchasing managers indices globally, which are leading kind of sentiment surveys, they have rolled over and are now consistent with growth of about 2.5%. So they're even below, I'd say, where consensus forecasts currently are. And the details within them were very concerning, I would say, Dan, in terms of new orders falling sharply, future output expectations falling sharply as well. But when we look at US consumer or US small cap confidence, which I've shown here on the left, this shows confidence among small cap companies in the States out over the next 9 months. And small caps are the bedrock of the US and any economy. This survey is around for the last, since the early 1970s, Dan. We're now at the lowest level since 1970s, early 1970s. So this is saying the small caps are suggesting, they're cautious about the outlook over the next couple of months. Similarly, if you look at consumer confidence levels, and I've shown them here in the middle chart for the Eurozone, UK, and the US, and I've used the Michigan survey in the States. The Michigan survey is around for 70 years, Dan. It's at its lowest level in 70 years now. UK consumer confidence is at the lowest level since the 1970s, early 1970s. In Europe, it's back to almost the lows that we got in COVID. So despite that positive consumer backdrop that I mentioned earlier, consumers are basically saying they're very cautious in terms of the outlook for their spending. And we have historically seen spending is very closely correlated with consumer confidence levels. So again, it's not boding well, I would say, in terms of what the outlook is for global consumption going forward. And lastly, just in terms of the 2s10s yield curve in the States, which is seen as the best indicator for recession. And again, when we look at the yield curve, what I'm saying here, I suppose, is as you go out to maturity in terms of longer dated maturity bonds, typically what you see is longer dated bonds have a higher yield because of the uncertainty over the long term. When the curve inverts at the 2s10 levels, what I mean there is the 10-year yield unusually is lower than the 2-year yield. And that reflects the fact that the Fed has raised rates at the short level to such a high level that the market begins to discount a recession as reflected in those lower 10-year yields. So what I've shown here on the chart on the right, Dan, is just the history of that yield curve going back to the mid-70s. And when the curve inverts, and again, when I say invert, it means the 10-year yields are lower than 2-year yields, that always has led to recession on average about 18 months after the curve inverts. So at the moment, the curve inverted in the States in April, went positive for a couple of weeks, but this week it has inverted again to the lowest levels it's been at since 2000. So the yield curve is clearly saying to us that the market's getting concerned that the Fed is raising rates to the point where it's going to cause a recession. And I said, it's saying that, the US growth is going to slow this year into next year, with a rising possibility of a recession as we go through the second half of next year in the States. In terms of which regions are at greatest risk, Dan, I would say Europe is the most vulnerable because of its, I suppose, sensitivity to what's happening in Russia and Ukraine, particularly around gas supplies. And again, people may have seen, gas prices in Europe have risen 25% last week. They're up 120% over the last month, Dan. Gas prices in Europe currently are 180 euros per megawatt hour. They normally would be 15 euros. So they're 12 times higher than normal. And the reason you've had it seen increasing concerns recently is that Russian supplies through the Nord Stream 1 pipeline, which is one of the main conduits for supplies of gas from Russia to Europe, have halved over the last couple of weeks. And people are fearful that Russia is beginning to weaponize gas supplies and retaliate in terms of the sanctions and support that Europe has given to Ukraine. Now, at the moment, that Nord Stream 1 pipeline is down totally from maintenance, Dan. It's going to reopen this day next week. If after that, those gas supplies don't revert to normal, I think there's a real concern that you could see gas supplies from Russia to Europe being cut off. And if that happens, I think there's a real risk that Europe goes into recession very quickly because of the further significant rise you could see in gas prices, but also the requirement to ration gas if those supplies from Russia aren't coming through. And particularly Germany and Italy are very vulnerable because they rely on Russia for over 50% of their gas supplies. So Europe, I think, is the most vulnerable, Dan. US is probably more resilient, as is Canada. Again, I would say, the levels of fiscal stimulus, or the stimulus we've seen there generally has been greater than what we've seen in Europe. I suppose US in particular is less open than other parts of the world, and they're less, I suppose there's less interaction with Russia, Ukraine as well. So I do think North America is more resilient. I do think in Asia, while growth may slow in China, it will still be positive, Dan. It'll probably be somewhere between 3 or 4% this year, below the 5.5% target that the authorities have. But even though it's slower, it'll remain positive, and that will mean growth in Asia will remain positive as well. So the way I'd rank them, Dan, would be Europe most vulnerable, North America next, and Asia to have slower growth, but still positive, while you could see a recession in North America.
Lenny, thank you for that. As your CIO, Anthony McGuinness, put it in Ilam's mid-year outlook, when markets become more volatile and weakness takes over from strength, we remind ourselves that panic is not an investment strategy, and that staying disciplined, diversified, and invested serves investors well over the long run. So diversification might be the best medicine here. And that said, in times of volatility, investors do typically flee to safety. So if we're faced with a global recession, which sectors would you expect to perform well?
Yeah, so we have a slide, and I think it's 2 slides on here, Dan. Yes, this one here. So energy has stood out this year. Energy would typically be seen as a cyclical sector, but obviously with the sharp rise that we've seen in energy prices, both gas and oil this year, energy is the only sector that actually has generated a positive return this year. But after that, it's the defensive sectors that have done well, the likes of utilities, healthcare, staples, and again in a slower growth backdrop where people are beginning to be concerned about the impact on growth, on earnings. These sectors tend to have more visible earnings, and I suppose they do tend to be more defensive in a growth slowdown. And as you'd expect, these sectors have outperformed this year. And in contrast, what you've seen is the consumer discretionary, industrials, technology, the more cyclical parts of the market, which are more sensitive to the growth backdrop, have obviously underperformed. Now, again, as the economy continues to slow and the risks of recession rise, we think that defensive cyclical mix that you've seen year to date will continue. So we do think that relative sector performance that you've seen year to date will remain a feature over the next couple of months. In terms of other parts of the market, Dan, some strategies or some factor investing like low volatility investing has actually done very well this year. Low volatility equities have actually outperformed global equities by about 9% this year. That reflects their bias towards low risk factors, low valuation as well, and the more defensive characteristics. So low volatility, more defensive factor investing has done well, and we'd expect that to continue. Other parts of the market that have done well, Dan, infrastructure stocks have outperformed again, and that reflects, I suppose, the fact that there's some inflation hedging within infrastructure investments generally, and they tend to perform better when you do see slower growth because of this kind of inherent protection that you have within that kind of inflation protection within infrastructure investments as well. And also real estate assets have performed well, and high yield investment has also done well. And alternatives as an asset class have also performed well. And we would expect those trends and patterns that have been evident in the first 6 months of the year to continue. So again, all that, I suppose, highlights the requirement and the need to have a diversified portfolio when you're seeing equity markets and bonds go through the difficult times that we've had over the first 6 months of this year. The more diversified your portfolio is in those defensive areas, the more protection that you have got year to date. And we think that's likely to continue, as I said, in the short term.
Thank you for that. Let's talk about Russia and Ukraine for a moment. If there was a more benign resolution to the Russia-Ukraine war, how do you foresee markets reacting to this?
I think the likelihood of that happening, Dan, is low. And again, if we see some of the comments that we've seen from Putin over the weekend in particular, he was saying, I think last Friday, the military conflict is only starting. He was threatening catastrophic energy prices, on the West because of the support that they've given to Ukraine, and we've seen that coming through in terms of those energy prices year to date. And again, this risk around those gas supplies to Europe. So I think the likelihood of a resolution happening is low, despite the fact that some European leaders like French President Macron are kind of working away in the background, trying to get to some negotiated settlement. And I think despite that, what we're likely to see is the stalemate that we've seen for the last kind of 2 or 3 months, and the military fighting. I think that's going to continue. So I'm not hopeful that you're going to see a short-term resolution. Even if you were to see a short-term resolution coming through, Dan, I think it's difficult for the West to significantly lift the sanctions that have been put in place. I think some of them would be rolled back, but if they were to lift those sanctions to any significant degree, I think it would prevent being a deterrent to Russia, and I think it would open the door to Russia to do something similar in other regions at some point in the future. So I don't think you would necessarily see a blanket lifting of those sanctions or restrictions that have been put in place. Now, at the margin, I do think you would see supplies beginning to improve around oil and gas, and I do think some of the issues that we had in terms of food exports from Ukraine and the blockages around the ports, and there seems to be some progress on that over the last couple of days. I think we could see some developments and some improvement in those areas, and that obviously would be helpful towards the outlook for inflation. And I do think you would get some kind of a short-term relief rally in equity markets, and I think bond yields would rise a little bit. But I don't think we kind of recover the losses that we've seen year to date, Dan, because I think the key drivers, as I mentioned earlier, are those underlying inflation pressures, which were already there before the invasion. Yes, they've been exacerbated by what's happened in Russia, Ukraine, but the key driver to markets this year has been that higher underlying inflation backdrop that we've had, the policy pivot from central banks, and the slower growth backdrop. And a resolution in Russia, Ukraine would help at the margin, but I don't think it would help us recover those losses. And I think we really need progress in those other issues before we could see a real bottom in markets and a real recovery coming through.
Lenny, thank you for that. Now, moving to monetary policy. As we're all likely aware by now, yesterday, Bank of Canada Governor Tiff Macklem raised the central bank's policy rate to 2.5%. That 100 basis point hike is the largest increase since 1998, and markets and economists were anticipating about 75 basis points. So analysts are already adjusting expectations, with some saying Canada will see 3.75 by the end of the year, up from their projections of 3.5. So this policy tightening could push Canada into a recession. Do you see the size and pace of interest rate hikes slowing down for the remainder of 2022? And are you seeing similar trends in other developed markets?
Yes. So again, we go back to this inflation issue, I suppose, and as you said at the start, this is the highest inflation levels we've seen in 40 years. And if central banks don't contain this and begin to bring it back towards target levels, they risk losing the credibility that global central banks have built up over the last 40 years in terms of battling inflation and bringing it down and keeping it low. So there's a real credibility issue for central banks here if they don't contain inflation, and also in terms of the ability to use some of those unconventional policies that they've had in recent years in terms of asset purchases and QE. If they don't bring inflation down, these will be blamed for this rise that we've seen in inflation, and their ability to use those unconventional policies going forward will be severely damaged. Now, if you look at the Fed, Dan, I would say as you continue to see higher and higher levels of inflation and exceeding expectations, we saw it yesterday, we saw a new high in US inflation of 9.1%. As that continues to be the case, the Fed appears to be getting more and more committed and determined to bring inflation down. And it continues to refer to, its resolve in terms of getting inflation back to target. It's referred to the risk of losing the public confidence if they don't get inflation back down. So I do think they are determined to bring inflation down from these very, very high levels. And if we look at policy, at the moment, be it nominal yields or real yields or the level of the Fed funds rate, as I mentioned earlier, compared to where these have been in previous cycles of high inflation, policy is still very loose. So the central banks need to continue to raise rates. Now, in terms of expectations, obviously expectations have risen significantly. If you look at the Fed at the start of the year, Dan, the expectation was the Fed funds rate would be 75 bips by the end of this year. It's already 150 bips, and the market today thinks it's going to be 375 bips by the end of the year. So the market's factored in 300 basis points of additional tightening compared to what it was thinking 6 months ago. And our sense is that policy to us still seems loose and not tight enough to actually rein in inflation and bring it back towards those targets. And our sense, Dan, is that the market currently is thinking 375 will be the peak in US rates. We think they need to go to 4 and above. So we do still see further tightening from the Fed and other central banks. I mean, you mentioned the Bank of Canada. Yesterday we saw rates being raised to 2.5%, 100 basis point rise. That's after 250 basis point rise that we've seen recently. And again, the concern that the Bank of Canada has, they're saying inflation is going to still be 7.5% at the end of this year. It's only April, Dan, that they were saying inflation was going to be 4.5% at the end of the year. So in the space of 3 or 4 months, that inflation forecast has gone up 3%. And again, the Bank of Canada, as elsewhere, is saying or sees the need to continue to be very aggressive in terms of this tightening of policy. Now, the market's saying Bank of Canada rates will be 375 by the end of the year. Again, our own sense is that's similar to the US, that they may well have to go beyond that because those inflation pressures that we've seen have broadened out. It's not just concentrated in a few narrow goods as it was last year around energy and car prices. It's now broadening to services. And the thing with services, Dan, is once it gets into the services sector, it tends to be a bit more sticky. So it's more difficult to get it down. So the central banks, as I said, to maintain that credibility, need to continue to be aggressive, we believe, in terms of this tightening of policy. And lastly, I just mentioned the ECB. At the beginning of the year, the ECB were adamant they were not going to raise the deposit rate in Europe this year. It's currently minus 50 bips. They're now going to raise rates for the first time in 11 years at the end of this month. They are saying 25 bips. The market's currently suggesting they need to do more than that. By the end of the year, the market currently is expecting the deposit rate in Europe to be about 1%. If anything, I think given the high levels of inflation that you're seeing in Europe, it's up at 8.1% and likely to go, 8.6% and likely to go above 9%. We think that the ECB may need to be more aggressive than the market is currently thinking, between now and year end. So overall, I think you're going to continue to see further rate rises coming through from the central banks until they're confident that they have tamed inflation and are getting it down. And I think while inflation will moderate between now and year end, I don't think it's going to be at sufficiently low levels for them to stop tightening policy by the end of the year. I think they're going to have to continue to tighten policy into next year. And it's only when you get to the point, Dan, that you're kind of seeing very slow growth or recession really becoming a high likely or probability that they will begin to pause and maybe cut rates at that point, which could well be the second half of next year. But I think in early next year, I think they need to go beyond what the market's currently discounting.
So building on that, 10 of the last 13 interest rate hiking cycles in the US have led to a recession. So do you think that the US Federal Reserve Chair Jerome Powell can avoid a hard landing for the US economy without being soft on inflation?
Yeah, and I think we have a slide on this, Dan, where we show the tightening cycle in the States going back to the 1960s, and there've been several tightening cycles. I think this is the 13th tightening cycle that we've had from the Fed, since the early 1960s. And the Fed at the moment is saying it hopes to achieve a soft landing in that they will tighten policy, get inflation down, and avoid recession, slow growth, but still be positive. The track record isn't great, Dan. We look back, of all those tightening cycles, there's only been 3 since 1960 where they've avoided a hard landing or recession. So I think the track record is suggesting that it will be very difficult to achieve this soft landing. And again, I would say reading between the lines, when you hear Powell speak and comment to the market, he's increasingly saying, the objective is to achieve a soft landing, but he says it's difficult to achieve. The market and economy will have to, take some pain as they tighten policy to rein in inflation. And I think reading between the lines, I think he's telling the market there is a risk that we won't achieve this soft landing and we'll have a hard landing in a recession. And again, as I said, history suggests that that's more likely than not.
Thank you for that. For investors that are concerned about rising interest rates, hedging against inflation, or a lack of returns, do fixed income assets still make sense for them?
So again, as we mentioned earlier, Dan, I suppose it's been very unusual this year, the weakness that you've seen in both equities and bonds. And people would have expected much, much better returns from bonds in this kind of fear of kind of slowing growth backdrop. But really, it's been the policy pivot that you've seen from central banks, driven by this high inflation backdrop, that's caused this kind of sharp rise in yields that we've seen year to date. Now, despite that, we still think there is a place for bonds, in portfolios, and there's a number of reasons for that. One, I suppose, is when you look at defined benefit schemes in particular, and I suppose some of them have kind of wage hedges or wage inflation built into them. Again, inflation-linked bonds will have served them well over the last couple of months in terms of protecting against this rising inflation backdrop and rising wage backdrop that we've seen. But also, I suppose, when you look at defined benefit schemes, their funding has improved substantially given the rise that you've seen in yields over the last couple of months. And with that, what they're now looking to do, and a lot of them are considering doing, is buying into bonds so that they're kind of hedging out that risk around rates, and kind of matching their liabilities closer. So I do think you will continue to see buying of bonds, but also after the rise in yields that we've had, Dan, globally, and particularly in Europe. For years and years, yields were so low, the potential returns in bond markets were very, very modest. And in Europe, you were actually seeing negative yields. Yields have now risen to the level where they actually do offer you a good carry and a good income stream. I mean, if you look at the US and Canada, you're getting over 3% on the 10-year yield now at this stage. Very short term, as I said earlier, you could see those yields rise a little bit more as the market discounts more tightening from the central banks. But in 12 months' time, we expect those yields in the States and Canada to be around where they are now, around 3%. So that gives you a return of 3%, over the next 12 months from those, which is, much better than the types of returns you could get when those yields were very low. And I said in Europe, you were actually getting negative returns. So I do think there's still a place definitely for bonds in portfolios. And our own sense is that a lot of the tightening has been discounted in markets at this stage. There could be a little bit more to go, but I think a lot has been priced in. And on a 12-month view, I said with yields around current levels in North America and probably lower in Europe, we do think you will see positive returns from bond markets over the next 12 months. So a much better environment than we've seen over the last 6 months.
Thank you for that, Lenny. Those that are focused on responsible investing have seen some rough turbulence in their portfolios this year. So what can you share with them that might provide a light at the end of the tunnel?
So as you said, Dan, I mean, ESG has really struggled this year, and it has underperformed. Now, when I say really struggled, it's probably underperformed by maybe 1% or so, and that really is driven by that energy outperformance that I mentioned earlier. Now, I suppose when you look at long-term performance of ESG funds and benchmarks, they have slightly outperformed market cap indices over the last decade, and they've significantly outperformed energy benchmarks. So again, I would say the long-term history of ESG is still positive. Now, everybody is aware at this stage that unless we address this climate issue, the implications for humanity and investment markets and economies in general are pretty negative. So it's an issue that people are very, very aware of. And I would say interest in the ESG investment agenda generally remains quite high. We can see that, I suppose, in terms of the flows that we've seen into ESG funds this year. They've been much, much better than what you're seeing in market cap equities. And again, I said that's a reflection, I'd say, of the increasing interest that you're seeing from institutional and retail investors generally. And this sustainability topic, Dan, it continues to garner more and more interest as people become more aware of the ESG agenda. And I would say as the whole regulatory environment continues to increase as well. And with that, you are seeing increasing demand from both institutional and retail investors, I would say, for credible ESG offerings from investment managers. Now, over the last couple of years, everybody's aware, I suppose, of the lack of investment or the lower levels of investment, Dan, within renewables compared to what expectations had been. But the commitment to renewables globally remains very, very high and steadfast. And we can see that across Europe, where there's a plan to invest over 300 billion in renewables over the next couple of years. And again, what we're seeing is similar programs being announced across the global economy. So that commitment is still there, and we will still see that coming through. And I would say among investors, Dan, what you're seeing is increased focus on net zero emissions, on decarbonizing portfolios generally. And I do think that all means that the ESG agenda is going to remain, at the forefront of investment strategies. And this theme is something that's going to remain in place. And with that, I think the returns will improve on a relative basis compared to what we've seen at the start of this year. And with that investment that we're seeing within the renewable space over time, I do think that will continue to kind of drive returns as this push towards, I would say, clean tech continues. So, despite the kind of relative softness we've seen in ESG this year, I think the medium to long term outlook continues to bode well.
Thank you for that. I know we're coming up against time. I want to make sure that we have some time for Q&A. We're sitting at 11:44. I think that we probably have time for one quick. No, we're at 11:45 right now. So, that was a really helpful discussion that puts some of these market moves into perspective. And I think that we should take some time and move over to our question and answer segment. So if maybe we can get our questions up on the screen here. Okay, top question. With current inflation from Jeff Gerwing, with current inflation at 7.7% and 10-year bond yields at 3%, does that mean the market is predicting inflation will come back down below 3% soon?
When you look at inflation forecasts within the market space, I think what you're seeing is that the expectation is that inflation in the States and Canada by the end of this year is going to be around, I would say, 7 to 7.5% roughly. And in 12 months' time, around, I would say, 4%. So the expectation is that it will moderate, but it probably will be slow to come down, I would say, Dan. So I think what the market is kind of suggesting as well at the moment is that the Fed is going to be successful, and the Bank of Canada and other central banks, as they tighten policy, they will begin to see a moderation in those levels of inflation coming through. The risk, I think, Dan, is that as the broadening out that we've seen of inflation, and particularly across the services side of things, where it tends to be more sticky. And again, what we're seeing in the US as well, and we've seen it elsewhere, I suppose, is the rental rates of inflation are increasing as well. I think there is a risk that perhaps inflation becomes more embedded than the market thinks. And while there is this expectation of lower inflation, and I do think we will get down to those types of inflation, that I mentioned, close to 4% in 12 months' time. It's still above the 2% targets that the central banks generally have, and it's still well above, I would say, what the central banks, the likes of the Fed, the Bank of Canada, would be comfortable with. I think the Fed and the Bank of Canada would need to see inflation below 3% and still showing signs of heading down 2%, towards 2% before they would become comfortable. I think what the 10-year yield at 3% is currently saying, Dan, I think is that, I think what you're seeing is maybe a flattening of the curves, or this inversion of the curve that I mentioned earlier. So while the Fed potentially is going to raise rates more than the market currently thinks, and the short-term rates will continue to rise, I suppose the 10-year yield being stable or maybe rising slightly, but less than what you see at the two ends level of the market is basically saying that the Fed is going to cause recession as it continues to tighten. So if they continue to raise short-term rates, that the fact that the 10-year yield is staying around 3% is basically suggesting you're going to see much slower growth and potentially a recession with lower inflation, but not necessarily coming back, as I said, below 4% by this time next year.
Okay, Lenny, thank you. And Jeff, thank you for your question. Next question up, Susan Grandy. Do you anticipate a relief rally out of China and other EM frontier markets as they come out of their pandemic lockdown measures?
Yeah, so in relation to China, I kind of mentioned earlier, I suppose, I do think there's a risk in China in particular that you're going to continue to see this kind of wave of lockdowns as you get these new waves coming through. We're even seeing it at the moment, and China began to reopen probably 3 or 4 weeks ago, and we're hearing news now of new lockdowns, smaller lockdowns, but still new lockdowns across parts of some of the major cities and major production regions across China. So I do think, so long as they continue with this zero tolerance policy, and I think that is going to continue until at least that 20-party National Congress in late this year. I think there's a risk that we're going to continue to see those lockdowns in China. And with that, I do think there's going to continue to be risks and concerns around Chinese growth. Now, the offset to that, Dan, is that the Chinese authorities are continuing to loosen policy, both on the monetary and fiscal side of things, to offset this risk to growth. I don't think it's going to be sufficient to cause, now you have seen some rally in Chinese equities, but I don't think it's sufficient to to allow that rally continue, given the level of risk I see around growth. And I only think when that zero tolerance policy is removed, and I think it probably could be early next year before we see that happening, that you really get, I would say, a more consistent, long-lasting rally in the likes of China and EM and those other frontier markets. And again, I think those markets are more likely to outperform when we've seen the bottom being reached in equity markets. And again, for that to happen, I think global central banks need to suggest that they're at the peak of the tightening cycle. And I think you need to see sentiment around global growth beginning to improve as well. And I think they're the kind of foundations or catalysts that are needed for China and EM to outperform on a sustained basis.
Good question, Susan. Thank you for that. And Josie would like to know: Do you think emerging markets will come back before U.S.? And I think you touched a little bit on this earlier. Maybe we can tell us what you
Yeah,
think.
yeah. So I suppose the one thing I would say, Dan, is that the US is underperformed this year because I mentioned earlier, I suppose the tighter Fed, the tech weight. Typically, what you see, and it's probably a little bit counterintuitive. I think as you go into the teeth of the recession, Dan, I think the US might begin to slightly outperform as we go into the teeth of the recession, because the US typically seems to be a safe haven market, and you get flows of money coming back into the States. So, despite those risks, I think for the next short term, I think US could continue to underperform. But as people really begin into recession, I think the US might have a short bout of outperformance, and then as they begin to look to the recovery as you come out of that and the new cycle happening, I think then you will get emerging markets outperforming. So I think there's kind of two or three steps to go before we get there, and the US kind of will have various stages of relative performance as we go through that.
Thank you for that, and thank you, Josie. Bill has a question: Has the idea of ESG investing taken a back seat to commodities and cyclical stocks, given the recent geopolitical tensions?
I wouldn't say it's taken a back seat, Dan. Again, I suppose the points that we mentioned earlier, I do think the ESG agenda is here to stay, and there's more people buying into it, and I suppose they see the benefits of it. And I do think, they're, when you look at trustees, I do think they feel a requirement to actually look more at the ESG agenda. So I don't think it's going away. Obviously short term, it's suffered because of the performance that we've seen in energy stocks. But I do think over time, as the level of investment in renewables is increased further, I do think you will see returns within the ESG space begin to improve. Now, very, very short term, Dan, energy has done very well through most of this year. Commodities have begun to roll over as people have begun to be fearful, more concerned about recession. Now, it's been very divergent within commodities. So metals have rolled over first. And again, China has been a key driver of the metals market, and we've seen, the slower growth in China impact the metals market. Oil has held up better because you do have tight supply relative to demand there. But what we've begun to see the last 2 or 3 weeks, Dan, is the oil price has begun to come off again as people discount the recession happening. So as the idea of a recession takes hold, I think we could see some short-term underperformance across commodities generally, and I think it's more widespread than just the metal space that we've seen over the last couple of months. And I think energy could be caught up in this as well. And I do think, with that, you should see some better performance from ESG in the short term compared to what you've seen in the first half of the year, and then medium to long term for those reasons we outlined earlier. I do think the ESG agenda remains positive overall. Now, having said all that, I suppose where do we see energy prices? There obviously has been a lack of investment, I would say, in legacy energy space over the last couple of years. You will see more investment, but that will take time to come through. So I do think the new equilibrium for energy prices, oil or gas, is higher than we and many others would have thought 12, 15 months ago, Dan. So, short term, I think those prices come off, but when they do settle, I think they settle at higher levels than was probably the consensus, as I said, 12 or 15 months ago.
Thank you, Lenny. And Bill, thank you for the question. Paulina is asking, do you see the rotation to value stocks being a longer trend in the markets?
So if you look at the very, very long term, going back several decades, Dan, value has consistently outperformed growth. The exception has been the last 10 or 15 years. And the reason that's happened is, I suppose, we've been in, a loose monetary policy environment. We've seen low growth, we've seen low yields, we've seen low inflation. And all those have been positive, for growth stocks, given the discount rate that you use to value those growth stocks. And I suppose the fact that growth has been scarce. So anything that offers growth has been priced at a premium. So growth stocks have done well. That's been the kind of macro backdrop down. The micro backdrop has also been difficult for value stocks, I would say, when you look at things like, the bank sector, which is, faced regulatory and capital issues post the GFC. And I would also say disruptors have obviously, caused difficult environment for some of the kind of more traditional stocks. So it's been a very unusual and difficult last 10 or 15 years. What we're seeing now is changing that, I would say, downward cycle to a more positive cycle for value stocks. So I do think, even though inflation is very high, it will come back and moderate. When it settles, I do think it'll settle at higher levels than it's done, pre-COVID, Dan. With that, I do think, we will be in a higher yield environment than we've been in historically, and all that should be positive for value stocks. Now, again, when we look at the relative valuation of value stocks, Dan, versus growth stocks, even though the relative valuation has increased over the last 6 months because of the outperformance of value stocks, relative to history, value stocks are still extremely cheap versus growth stocks. And also, I would say, Dan, when we look at, relative performance of value versus growth compared to what nominal and real yields have done recently, levels of real yields in particular are suggesting there is still short-term upside in value versus growth. So our sense is, the last 10 or 15 years was very unusual, very positive for growth. We do think going forward that macro backdrop is changing more in favor of value. And again, we think the kind of outperformance you've seen from value over the last 6 months is more likely to be a more medium to long term issue within the market. So we do favor value stocks over the medium to long term, and kind of see what we've seen over the last 10 or 15 years as an exception.
Thank you, Lenny. Thank you, Paulina. I think we have time for one more question here, and we're going to go to Bessie's question. And I think back to the comments of your CIO earlier that we talked about. So in this unstable market, what would you tell clients? What do you believe clients need to know?
I would say, again, the benefits of diversification that we mentioned earlier, Dan. So, at the moment, what we're seeing is, very weak equity markets. You've obviously seen very difficult bond markets over the course of the year. But if you'd had both those assets, and historically you would have expected, the bond weight to offset maybe the weakness that you've seen in equities, that hasn't happened this year. So diversification into other areas like alternatives, like infrastructure, like value, like low vol, all those would have, given you benefits this year. And I think that diversification in what's likely to remain a volatile environment will continue to be beneficial to clients going forward. The other thing, Dan, I suppose, is, equity markets will bottom. We're cautious short term. We don't think they're fully discounting the kind of slower economic backdrop or the risk of recession. And we do still see in the short term further downside in equity markets, but equity markets will bottom, as they always do. And as I said, they discount forward by 9 or 12 months. And when they begin to see a recession happening, they'll look out the other side, see that we will have a recovery, and equity markets will recover. And over the long term, as I said, we still see equities as one of the kind of best returning assets on a long-term basis. So it is very difficult when we're going through these periods, but I would say, don't panic. Don't be unsettled. Overly unsettled in these markets. We will see a bottom, as we always do, and we will see equities recover. And I do think over the medium to long term, they will continue to give strong returns to clients. So that diversification, I would say, Dan, and that recognition, don't panic. We will see better times for equity markets. And again, going back to bonds, those yields have risen now down to levels that they do provide protection, in an environment of uncertainty. We can see that through June, Dan. We saw how US 10-year yields got up to 350. They got all the way back to 280. So they're at levels now where they're beginning to provide some protection in an environment where you're getting some questioning of what the economic backdrop is going to be. And they're at levels where those yields give you a reasonable level of income stream. over the next while as well. So again, there is some value appearing within the fixed income space.
Thank you for that, Lenny. So that's all the time we have for questions today, I'm afraid. Thanks for joining us today, Lenny. Thank you again. The clarity on these questions helps make the waters we're sailing in just a little less murky. And I hope everyone who joined us today took away information that you can use to help keep your clients on course. Now, Canada Life is proud to bring you world-class solutions to address our increasingly complex investment landscape with competitive compensation that reflects the value you bring to improving the lives of Canadians. We've invested in our people to better support you and will continue to invest as our wealth offering grows. We've dedicated teams who specialize in tax and estate planning, securities, and high net worth investing, as well as world-class wholesalers. And our goal is to give you the service and advice you need when you need it at the level that your clients expect. From coast to coast, you have tailored support for your specific market's needs. We're also continuing to invest in you through new tools and programs, helping you access global experts that can help fuel the growth of your business. You'll hear from your wealth wholesalers in the coming days to talk about what we've discussed today and how Canada Life Solutions can help you and your clients navigate challenging times today and in the future. So, and please reach out sooner if you'd like to talk to them sooner than this. And finally, a reminder that following the session, you'll receive an email with the recording of this event. Be sure to tell us what you thought about the event by completing a short survey. It's going to appear on the screen in just a moment. And on behalf of all of us here at Canada Life, we need to thank you for your time today, but also thank you for all that you do to help Canadians meet their investment goals and help them navigate the markets that we're facing now. So with that, I'll say have a safe summer out there, everyone. And thank you again for taking time out of your day to join us. Have a great afternoon.